Thanks so much, Marty. It's great to be back. And so, guys, what I'm going to do is I'm going to say a little bit about this subject of leverage in PE and liquid PE and sort of related topics to that. And then I want to dive into, sort of broaden, pull back the lens to talk a little about what's going on in markets generally, what's happening with inflation, how it's affecting markets, how it's going to affect markets, both public and private, value and growth, and so forth. And then I'm going to try to do that using a pedagogical technique, just talking really fast, because my hope is to take
Randy,
lots of questions.
Is there some way that you can speak louder or turn up your volume?
I don't know how a person would do that. I'm on a cell phone. I mean, if I turn up the volume, I'll hear you better, but it won't make me any louder to you.
Okay, great. Okay, no worries.
Normally, people complain my voice comes through the phone too loud, so I think maybe you need to turn up the speaker at your end.
It sounds like a beautiful sparrow.
The answer is I can talk louder. So that's the one thing I do control. So I will talk loud and fast. And then I'm hoping to get lots of questions from you guys, because I know people have a ton of questions about what's going on in markets. So let's start with and by the way, Marty was mentioning the talk I gave. We do a webinar series for PEO where we basically generally once a quarter, I'll do a talk. Jean-Louis and I together. Jean-Louis is my co-founder. He's I think in the room. Jean-Louis Leloger, who co-founded Strategic Value Partners, $20 billion private equity and hedge fund firm. And we do a webinar every quarter where we take on some of the biggest issues facing the economy. And if you're interested in joining us by Zoom for those webinars, we'd love to have you. So shoot us an email. I'll probably reach out by email to all of you guys and just respond to that email. And we'd love to have you as folks we talk to.
And Jean-Louis is here right now, so thanks so much.
Yeah,
he's in the room.
Give a wave, Jean-Louis. And so in terms of leverage, first, there's a lot of talk about the leverage in private equity. And what I'd say is it is significant, right? I mean, obviously there's different forms of private equity. Venture capital is not really levered, et cetera, et cetera. But if we talk about LBO, which is the heart of private equity and the biggest part of private equity, sure, the L stands for leverage. Those companies are leveraged. And they aren't quite as leveraged as it sometimes seems. A typical deal is about 3/4 debt. So on the one hand, that's a lot, right? That's way more than you would typically see in a company for 3/4. If it's a $100 million company, 75 million of debt and only 25 million of equity. On the other hand, it's fair to remember that public companies also have debt. And a typical public company is about 30% debt. Okay, so 30 million of debt, 70 million of equity on a $100 million company. But the companies that private equity deals with are what we refer to as LBO-able companies, right? And what's an LBO-able company? Well, that's a company that is capable of handling that very high level of debt. If it's not, then the bank isn't going to lend you the money and there's no LBO deal, right? No LBO, you might say. So you're going to have to compare apples to apples here. If we say, how levered are these PE deals? Because sometimes people will say, oh my gosh, all this private equity is jamming all this leverage into the financial system. Isn't it terrifying? And what I'd say is, it's something to watch, but it is, I would not say terrifying. First of all, you add up all the PE in the world, it's 6 trillion, which is a huge number, but it's only like 3% of global capital markets. So that's not an explosively large amount. And then second, if you look at those LBO-able companies, right, that in the public markets, these are companies with low multiples, high profitability, high payout ratios, and low risk. If you don't have those 4 qualities, the bank is not going to let you borrow that much money. Companies like that in the public markets, of course, have more debt on them than typical public companies. A little biotech company, which is not LBO-able, is probably going to have no debt or virtually no debt. The kinds of companies that can be LBO'd might be 50% debt in the public markets. So if you think, well, you're taking it from 50% debt in the public markets to 70% debt in an LBO deal, yeah, you're going to have to lever 1.4 to 1. It's not nothing, but it's not 3 to 1, 5 to 1, 8 to 1. You sort of hear these numbers thrown around. Oh my gosh, it's 6 turns of leverage. That's not what's really going on. Compared to a comparable public company, you're only levering a little. And honestly, that was the inspiration for us to create PEO Partners. What we do with PEO Partners is we deliver or at least work to deliver the performance profile of private equity, but while being liquid, while using public companies and staying liquid. And how do you do that? Well, first, you have to identify those exact same kinds of LBO-able companies, because those are the best performing companies out there. The companies the LBO firms buy in the private markets, those same kind of companies perform great in public markets. High profit, low multiple, high payout ratio, low risk. Those are the best kinds of companies. Any quant will tell you that. And then we copy the industry allocation of private equity, because private equity does a phenomenal job picking industries, and we have the data on their industry tilt. So we're going to match those industry profiles. And once you've matched those two, and then you match the leverage of PE, which we can do because it's not that much, then you overlay a hedge on top of that so that when the market crashes, you get that wonderful aspect that PE has where it doesn't crash too much in a crash. And now you're able to get a PE-like performance profile because you're capturing their main sources of alpha. And while it's true that PE can make operational improvements to the companies, and we're holding a diversified portfolio of hundreds of LBOable public companies, so they're not going to let us, tell them how to company.
Oh, Randy, we lost your voice. Randy, can you hear us? Randy? Okay, we lost Randy. Hold on a second here.
Hey,
Randy, we cannot hear you.
Match LBO.
Oh, much better.
Okay, can you hear me now?
Yeah, Randy, if you can rewind to 2 minutes ago, that'd be great.
Okay, not sure what happened there. So the upshot is that if you look at traditional PE versus liquid PE, obviously the big advantage of liquid PE is that you have liquidity, that you can get access to it without having to have tens of millions of dollars, and that you have the flexibility to put money in when you want. Traditional PE is triple illiquid, right? A, you can't take your money out. Okay, you can maybe live with that. B, they call you at random, unexpected times and call down capital when you least expect it. That is very stressful. You have to keep a lot of money on the sidelines waiting just in case a capital call comes in. And then sometimes when you're perfectly allocated and you're thrilled with the amount you have in PE, they send you money back. They say, hey, we sold something, we're giving you the money back. Well, it's great to take the win, but at the same time, you'd like to put that money right back into PE, but you can't. If you invest in a new PE fund, they're going to take 5 years. They're going to take 5 years to download that capital. So so to draw down that capital, I should say. So the question then, of course, with liquid PE is, well, can you get the performance of PE on average, given that you can't make operational improvements to the companies? And what we show, and I don't want to spend more time on this because I want to get into broader market stuff, but what we can show you, I think, is that we really can match or match PE type returns. And the reason is that although on a gross basis, we're going to be a little under PE because we can't make operational improvements, on a net basis after you capture the fees. I teach at Harvard Business School, and for 25 years, I've been sending my very best students off to these private equity firms, and they're phenomenal, right? They're so smart and they're so good. And why do they want to go work in PE? Because it's the best paying job on Wall Street. And where does that money come from? It comes from fees from investors. Once you add up operator fees, monitoring fees, origination fees, management fees, and carried interest, you're talking about 700 basis points a year in fees. Liquid PE more like 100 basis points. And so that gap more than makes up for the difference in the edge that PE has from being able to make operational improvements. But let me get into a broader lens on what's going on in the economy, because I think the leverage part is one piece of the story of what's going on in the economy, but obviously people are very concerned with inflation and recession. And so I wanted to say a little about that and then take some questions on that subject. What's going on with inflation? There are two schools of thought on what has driven this large amount of inflation. And I don't think that this has been as discussed as it should have been, given how much people are concerned about inflation. On the one hand, you have the fiscal theory of inflation. And this theory is being most promoted by my former dissertation committee advisor, John Cochran, who's now a professor at Stanford and the Hoover Institution. Super brilliant guy and incredibly kind and thoughtful. I've learned so much from him. And so the theory that John is working with is that the inflation rate essentially is a price for the dollar. And the price of the dollar is based on what the world thinks is going to be the US government's ability to pay its debts without having to print a zillion new dollars, right? In other words, if the tax base is sufficient to pay the debts, then you say, fine, we don't have to print a lot of new dollars in order to pay off what we owe. But if it's not sufficient, then you're going to have to print a gajillion dollars in order to pay off the debts. And then the value of each dollar is lower, and that's inflation. Okay, so that's the fiscal theory. And you can see it's got a nice intuitive appeal to it. The idea that inflation is sort of a market price of what those dollars are worth. So the more you run up the primary surplus, the more we should expect that the market says, gosh, they're going to have to print a lot of dollars to pay that off. And therefore, the more inflation you'd expect. And so the fiscal theorists say, look, we went deep into debt, right, to get through COVID and for other reasons, other bills that passed and so forth. And as a result, the government is going to have to print dollars in the future. And that's why we're seeing inflation. Okay, so that's one theory, is we ran up all these deficits. And if you look at the size of the primary surplus relative to the money base, blah, 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 what you would argue is we're going to need to see, under the fiscal theory, between 25 and 40% inflation total. I'm just, in other words, adding up all the years, adding up future years. So now we've already had something like 9%, right? And really, you should do this all relative to a baseline of 2%. So let's say 2% is normal. So we've had maybe an extra 7. And so let's say you said we need to have 25 and we've already done 7 of it. So we have 18% more to go. So that means we could have inflation 6% higher than normal for 3 years. That would be 8% annual inflation for 3 years. So the current level could hold. Or it could be 3% higher than normal for 6 years, or it could be 1% higher for 18 years, right? Those would be examples of ways that the currency could go up and up. And under the fiscal theory, the Fed does not really control how much inflation we're going to have. All the Fed can do is control how soon it comes. So they can make it 2 years of monster inflation or a little bit every year for a very long time. They can spread it out or cram it in, but they don't really have much more control than that. So that's the fiscal theory. Alternatively, you have kind of the traditional view of inflation that says, look, the reason we had inflation is we gave everybody a lot of money and they started spending it. And we had various shutdowns of things, some government force, some just because people didn't want to go to a movie in the middle of COVID. And so what you have is too much money and too few goods being produced. And so if you have people have more money, but there's less stuff for them to buy, surprise, surprise, you get inflation. Like that's just a given. And then when you add into that, what we will loosely call supply chain imbalances, which is to say anything that caused production to slow down, right? Like, let me give you an example real quick on the airlines. So what happened with the airlines? We knew that nobody was going to be flying for a long time under COVID. What we didn't want was for all the airlines to shut down, go out of business, and break up those organizations, because we knew the economy would come back someday. And you're going to want Delta Airlines to be there to fly you around. If everybody has to start new airlines from scratch, it's going to be a nightmare. It's going to be a disaster for the economy. So the US government gave $54 billion to the airline industry to say, please stay in business, keep things going. And the airlines took the money, but then they still kind of let 30% of their workforce go. The pilots, the luggage handlers, the flight attendants, like they, through attrition and early retirements and blah, 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 30% of the people were gone. So then what you find, the economy comes back. There's not enough people to fly all the planes, right? Because they let the pilots go. Now, did the airlines do what they were supposed to do? I don't really know enough about the airline. I'm not accusing them of stealing the money. There are people who are making that accusation, but I can't say that that's true. I don't know. What I am saying is that a supply chain imbalance? You can call it a supply chain imbalance if you want. I'll use the phrase supply chain imbalance for convenience for this sort of thing. I'm going to mention one more, which is even more important than the airlines, which is oil. Remember a couple years ago, the price of Brent crude went negative. If you could drive a truck up to the wellhead and take on oil, they would pay you to take the oil away, right? Now, when the price goes negative, guess what? People stop producing. They shut down oil fields because the oil is not worth anything. So of course you're going to shut it down. Then the economy comes back and you have to start those fields up again. But that takes time. You've got to get all the riggers. You got to get those. You got to hire people. You got to organize things. There's a lot that needs to be done. And so what happened is, look, oil production this year has been higher than it was 2 years ago, right? But it hasn't ramped all the way back up. And that takes time. And so when the economy came back fast and the oil production came back slow, guess what? Inflation, right? Supply chain imbalance, sure. Whatever you want to call it. So the upshot is now we're catching up and the oil prices are starting to come down, but slowly, right? And okay. So old school story is too much money chasing too few goods. Well, what's going on with that? Well, the money that was handed out through the various COVID stimulus packages is mostly spent, right? Almost all spent. So I'm not sure there's a lot of extra money floating around. What about the supply chain stuff? It seems like it's going away. I haven't seen a lot of articles about backups at the ports lately, right? It seems like that's getting solved. So if you look at those old school stories, it seems like inflation should be going away. But if you look at the fiscal theory, it says, no, we massively increased the primary deficit. And so therefore, we're going to have to pay with inflation. And all you can do is do it faster, do it slow. So there's going to be a real test of these two theories, okay? If you want to worry about inflation, here's a worrisome way to look at it. Larry Summers did a paper just recently where he showed that if you measure inflation the same way that they did it back in the 80s, because the people in the government, they do a good job constantly trying to update the definitions in the smartest possible way. But if changes occurred decades ago that now mean that the numbers are not apples to apples, if you use the current methodology on the 1982 inflation, it's not like 15% like it showed in the official statistics, it's 9.1. So the inflation now is just as high as we had in the 80s. And back in the 80s, they had to push short-term interest rates up to like 16% in order to in order to solve the inflation problem. So that would be the scary way of looking at it, right? Is, oh my gosh, rates are gonna have to go up, right? An alternative, a less scary way of looking at it is, if you take out, look, last month there was zero inflation. If you include just the overall CPI, it went up zero. It actually went down a tiny bit, right? Now, why is that? Well, it's because oil prices went down so much, right? Because the oil production is finally catching up. So economists like to look at core inflation. They say, take out food and fuel because they can mislead you because they're so volatile. So let's take those out. Well, then what you can see is over the last few months, core inflation on an annualized basis on monthly, the headline number is like 6, 7, 8% because it's including what happened 3, 6, 12 months ago. But if you look at just what's happened over the last few months, it's about 3.5, okay? 3.5% inflation. So now there's the next question you have to ask yourself. Is that scary high or is it fine, right? The Fed's
I'm sorry, Randy, yeah. I just have to interrupt you here. So when you talk about inflation is an increase in price, right?
Right.
But when you say it's 3% inflation, that doesn't mean the prices have come down. Is that correct? Or
no, they went up. They went up. So let me say this very carefully.
But the rate of going up is decelerating. Is that what you're saying?
I'm glad you asked. In fact, let's say it this way. There's two things. We love our 2x2 grids at HBS, right? And there's two things you need to think about here. One is, do you want to look at the overall or do you want to look at the core? If you want to know how much people are hurting, you need to look at overall inflation. Food and fuel are a huge part of people's budgets. If those are way up and nothing else is up, people are feeling a lot of pain. And no economist will ever tell you otherwise. They won't say, oh, well, the core's not up, so don't worry about it. The pain is real if food and fuel are going up. Now, at the moment, fuel's coming down. But the point is, when it was going up, that was real pain, okay? On the other hand, if you're trying to predict future inflation, it's probably a good idea to not look at the food and fuel because fuel went way up, but we knew it was going to come back down. And so if you're predicting the future, you don't want to say, oh my gosh, the headline inflation is so high, it's going to keep being high, right? So you have to recognize that certain things go up, but then they come back down when people adjust. Okay, so that's one thing, core versus headline. The other thing is, do we look at the last 12 months or do we just look at the last month or two? Now, looking at the last 12 months is very important for knowing how much pain people are in, right? Because if those things are running up and they didn't get a raise, they are having trouble buying the stuff they need to live, okay? So last 12 months is really important. On the other hand, if you're trying to figure out what's happening right now, you want to look at like this month and last month and so forth. So for predicting the future, the one I like is the core, right? So it's not artificially low because gas prices fell, but it's just the last month or two, and that's about 3.5. So if you ask me, if the Fed didn't do anything else, we should be looking at 3.5% inflation, plus or minus whatever happens with food and fuel, which could go either way, right? So some people, the Fed's position is we are taking it down to 2. It's got to be 2. That is the target, okay? Look, I lived all through the Reagan and Clinton administrations and George H.W. Bush. and things were pretty good. And inflation was 3.5%, 4% then. It wasn't like a horrible disaster to have inflation at 3.5 or 4. But I understand the Fed's position. Their feeling is if they can rip off the bandage and get us back to 2 in a hurry, then we'll be back on path to 2 forever. If it's 3.5 or 4, then something weird could happen and you could be back at 6 or 7. So the Fed is going to push hard to get it to 2. And that means I expect them to keep raising rates until it's obvious to them that we're in a recession, and then they might back off. And
Randy,
look,
I think did the ECB announce 0.75% rise today, right?
The Europeans have been slower to raise rates, and as a result, they now have a lot more inflation than the U.S. did, right? So the European inflation came a little later. So they were a little more patient, but now they're getting massive inflation. And of course, part of it is the horrible situation with gas prices there. Natural gas is, I think, $7 or $8 here and $70 in Europe, 70. Just enormous. And that's obviously because of Russia and the war and all that stuff. And we'll be here all day if you get me talking about Russia and Ukraine. So let me stick with inflation and the markets for a sec. So here's the question. What should we expect from the markets? Well, so just to finish on inflation, and again, happy to talk more about it, people have questions, but to finish momentarily on inflation is to say, my view is they have successfully gotten inflation to an acceptable place, but not to the place they want to get it to. And so they could say, we're kind of scared that maybe a recession's coming, let's stop raising. If inflation's at 3.5, that's okay. But every signal they've given is that's not their plan. Their plan is to keep raising until it's either down at 2 or we're in a recession, and they just don't want to make it too damaging. Okay, so that's that part. All right, so now let's talk about the stock market. Okay, so what's happened so far? Well, if you want to pick, again, there's always all these different rates to look at. There's short rates and there's long rates and there's inflation rates and there's core and there's headline. If you have to look at one interest rate number to help you understand the stock market, if you only remember one thing from this talk, remember this. If you have to look at one interest rate number to understand the stock market, the one you want to look at is the 30-year TIPS rate, 30-year Treasury inflation protected securities. Why 30 years? Because stocks are long run assets. They're about what's going to happen over decades, not about in terms of their cash flows, right? A company is valued. Tesla's worth a lot, not because they're going to make a lot next year, but because people think over 100 years they're going to make crazy amounts of money. Okay. And why the TIPS? Why the inflation protected bonds? Because the earnings of companies go up with inflation. So if you're going to have inflation adjusted cash flows, you have to use an inflation adjusted interest rate to discount them back. Okay. And I would spend an entire day on this at Harvard Business School because that's such a deep concept, but you guys probably all know that already. So I just want to remind you of what you already know. The earnings and dividends go up with inflation. So therefore, you need to use an inflation adjusted interest rate to discount them. And that is the 30-year TIPS rate. The 30-year TIPS rate in November was minus 0.5%. You got inflation minus 0.5. Okay. The 30-year TIPS rate as of a couple of weeks ago when I looked was +1. I think it's a tiny bit lower than that now, but it was +1%. So the 30-year TIPS rate moved by 1.5%. Now, you guys know how bond duration works, right? If you have a bond, you take the duration of the bond and you multiply by how much interest rates move, and that tells you how much the bond price moves. So if you have a bond that's a 10-year zero coupon bond and the interest rate moves by 0.75%, then you lose 7.5% of the value of the bond, right? Okay, the stock market is like a risky bond, and it's like a risky bond that has a duration of probably around 50. So if the interest rate moved 1 to 1, let's call it 1%, and the stock market has a duration of 50, you should expect the stock market to fall 50% just from the interest rate move, ignoring any bad economic news we got, right? And yet, we haven't seen that kind of drop in the stock market, right? And so that is pretty surprising. Now, go one step further. There's broadly, let's talk about two kinds of stocks. You've got growth stocks and value stocks. Obviously, these definitions are loosey-goosey, but fundamentally, when I say growth stocks, think of companies like Tesla, where the profits they're going to make are mostly way out in the future. And when I say value stocks, think of like some kind of boring old oil services company where the profits are mostly coming very soon. You're not thinking that they're valuable because they're going to make you money in 100 years. They're going to make you money the next 5, 10 years. Okay. which one cares more about interest rate moves? Of course, it's the growth stocks. When the Fed lowered rates when COVID hit, growth stocks shot up like crazy. And that made sense because those future cash flows 30 years from now had their value massively increased by a cut in interest rates. But what goes up must come down. So the growth stocks have gotten terrible, terrible news just on interest rates. Again, forget any economic news, just on interest rates. Growth stocks, they have a duration of, let's say, 60 or 70, and then interest rate moves 1%. You should see massive drops in growth stocks. Value stocks might have durations of only like 15. Interest rate moves 1%, you only lose 15%. I would say to you the following. The market does not seem to have dropped as much as you would think it should, given how large the real interest rate move is. That's the first point. The market does not seem to have come down as much as you would have expected. Here's a quick, simple way to say this. I know I'm almost out of time, so I'll be fast. A quick, simple way to say this is this. The day before COVID hit, the market was around 3,600, right? Now, since then, we've had about 10% worth of inflation over 2 years. So you'd think the market would be about 10% higher, 3,960, which is almost exactly where the market is. So you would say if there was no news on interest rates and there was no news on the economy, and if the market was properly priced in 2019, then you'd say the market should be right around 4,000, which is where it is. Now, interest rates are right back to where they were in 2019. So that part works, okay? Everything's kind of where it ought to be, except, long-term interest rates. But the economy looks way scarier than it did. In 2019, things were going amazing, right? Now the economy looks really scary. We might be in a recession now. I sort of don't think so, but I think we probably will be next year, and we certainly might be even now, right? So the economy looks way worse than 2019, and everybody I know thought the market was expensive in 2019. So how the heck, with interest rates in the same place, is the market at the same price, inflation adjusted, as it was in 2019? It feels like it ought to be lower. Okay, but what really should happen is growth stocks should be lower. Value stocks arguably have fallen in the ballpark of the right amount, but growth stocks feel like they have not fallen enough. And so let me just, if you'll forgive me, say one more word about liquid private equity. One reason we're so excited to be doing liquid private equity in this environment is that we are hedged. So if the market comes down a lot, the derivatives that we buy protect us from that hedge. But then also B, the companies we're holding are those LBO-able companies. Those are the companies with high current cash flows. Those are the companies that should be hit less badly by the phenomena we're talking about. So if the Fed continues to raise rates and that leads to recession, it's going to be very bad for growth stocks, moderately bad for value stocks, pretty bad for the market as a whole, but we think that liquid PE will be rock solid in that circumstance. And so thank you. So I'm happy if Marty thinks there's time for questions. I'd love to answer more. I tried to cover a couple things that came in on the chat.
One or two questions.
Yeah,
and I think you might have answered one, which is where's the stock market going to be in 3 months?
Yeah, so I feel like I did my best to cover that. I mean, look, I never want to pretend that I know what the market's going to do over the next day, week, or month, but I've told you everything I'm comfortable saying, that I actually do have an opinion on that. So were there others that I missed in the chat because I was talking too fast to hear it coming through?
Any questions here? My uniform question is, what about contagion, right? The Fed is withdrawing capital from circulation around the world. People have dollar-denominated debt all around the world, and how they're going to pay off their debt, right? Whether it's Latin America or Africa or wherever, right?
It's a great question. I rather than pretend I know more about that than I do, let me say another contagion issue that really does worry me and that I would kick myself if I didn't mention, and is the mortgage, and that's the mortgages, right?
Yes,
so in other words, we talk about interest rates being up. Think about real estate, right? Here's something amazing. Like, here's what people may be wondering: why isn't real estate down more? I mean, after all, the mortgage rates doubled, right? 3% mortgages for 30 years are now 6%. So how the heck is anybody buying anything? Here's how it works in real estate markets under these conditions. I think this is something that has not been widely discussed. So I feel like there's actually an insight here. So hopefully you guys agree. If not, if I'm wrong, shoot me an email and tell me I'm wrong. Think of it this way: if you bought a building last year for $1 million and you borrowed a 3% 30-year fix, so you're paying $30,000 a year. Okay, and let's say you're renting it out for $40,000 a year. So you're doing fine and you're happy with that investment. It's a good investment. Okay, suppose you need cash. You decide you'd like to sell your building. And by the way, the rents are up to $44,000 a year because of inflation. So you're like, great, my building should be worth more than $1 million. Maybe it's worth $1.1 million. You go to try to sell it, and the buyer says, no, I'm going to be paying $60,000 a year in mortgage because mortgage rates are up so much, but I'm only getting $44,000 in rent. I can't pay $1 million for this building, let alone $1.1 million. I'll give you $700,000. So then, of course, I'm going to say, well, then I'm not selling to you, right? Because I think it's worth $1.1 million. I'm getting this great rent flow. How does that make any sense? Why is it worth $1.1 million to me, but only $700,000 to the buyer? The answer is, it makes perfect sense, because when you own a building with a mortgage, you have two financial assets, the building and the mortgage. The building has gone from $1 million to 700. Of course, I made up these numbers, but it's in the ballpark.
Sure, understood.
The building's going down. The mortgage has gone from being a break-even mortgage worth zero to being worth $400,000 because you've got locked in 30 years at this ridiculously low rate when rates are up to 6%. If you sell the building, you cannot transfer the mortgage. This is a fundamental fact of banking life in the Western world. They will not let you just flip the mortgage to the next guy. And so therefore, you have to throw away $400,000 if you sell the building. So what happens? No transactions occur. Now that won't go on forever because people's arms run out and their mortgages run out, and some people bought without a mortgage. So there are people who will sell, but nobody with a locked in low rate mortgage will sell. So then you see no transactions. And then for long periods of time, months, maybe even more than a year, people will kid themselves the prices have not fallen because they'll say, I haven't seen any transactions. There's nothing on the market, right? My wife just said this to me the other day. There's nothing on the market in Cambridge where we live, right? But what's going on is not that there's nothing on the market because there's so much demand, they're all selling. What's going on is there is a mismatch between what things are worth to buyers and what they're worth to sellers. And I think that real estate prices are down. And so then if you ask me, am I scared that real estate is way down and this is eventually going to contagion itself through to the banks and the financial system and so forth, like 2008? I think we have better protections in place in 2008. I'm not terrified about it, but I'm a little nervous about it. So that's my contagion answer.
Randy, the great irony of what you're saying is that somebody gave this exact example as happening in the real world yesterday during our real estate panel. So I mean, what you're thinking theoretically is really happening in real time. Yeah. And there's this gap in rationale in the market valuations, right? But I mean, it's kind of like that California dilemma where nobody will sell their house in California because once they do, they have to buy something far more expensive, right? Or they have to move out of state, right?
Well, no, because the crazy thing where they have the low property taxes, but the next person pays for it. Exactly. What I want to point out to everybody is this is all completely rational. It's sort of crazy that you have a situation where it's worth $1.1 million to me, but $700,000 to the buyer. But it is completely rational because of this rule that says you cannot transfer the mortgage with the house. The implications of that are huge in an environment like this. Now, if interest rates come back down, it may end up not mattering very much. So maybe mortgage rates won't stay up. I think they're already down a little from when they hit 6. But if mortgage rates stay high, that is the thing to watch. If you ask me, why am I scared about a recession? My number one reason is mortgages flowing through to construction, banking, and everything else. And my number two reason is oil shocks almost always lead to recessions historically. However, I'm hoping this oil shock will sort of cure itself quickly enough as they ramp back up production that it won't do it this time. But when you put together and then of course the third one is the Fed pushing up rates. So you put those three together, high interest rates, and then the mortgage rate specifically, and then the oil shock, there's a lot of indicators that would normally suggest a recession. Look, right now, unemployment's at all-time lows. So, it doesn't feel like we're in the middle of a recession, but it's an unprecedented situation. We've not had a pandemic like this, and nobody quite knows how it's all going to play out. And so as an economist, I'm like, this is great. We're going to learn so much over the next couple of years. But as an investor, it's like, I'm really, really glad to be hedged, and I'm really, really glad to be tilted towards those high cash flow companies.
Sure, Randy. And just another point is that I've read somewhere that there's 2 to 3 times as many Americans late on their mortgages as there were during 2008. So, if there's foreclosures, you'll see people with, torches and axes in the streets saying no. Exactly. Right. So I don't think people are going to, there's no replay of 2008. It's not going to happen where 5 million people will accept having their homes foreclosed on. It just won't happen again. So, but it's very fascinating. And this is really a master class. Thank you so much. We always look forward to your presenting.